So good afternoon, all the participants, and welcome to this second day of Valuation CP program. And today's topic is Valuation of Startup Entities. अब पिछले तकरीबन 15 साल से हम स्टार्टअप सुनते आ रहे हैं, आज तक ढंग से पता नहीं लग पाया स्टार्टअप क्या है। तो अंकित जी आज उसकी वैल्यूएशन बताएंगे कि आपके हाथ में कुछ नहीं है लेकिन फिर भी वैल्यूएशन अच्छी खासी आ जाती है। और किसी की वैल्यूएशन आज 1 लाख करोड़ रुपए है, कल 25,000 करोड़ रुपए हो जाएगी, फिर परसों 2 लाख करोड़ हो जाएगी। और ऑल वैल्यूएशंस आर एक्सेप्टेबल, क्योंकि फ्लिपकार्ट का मुझे पता है कि $15 बिलियन से $6 बिलियन भी आई थी और आखिरी में बिकी तो $20 बिलियन पे बिकी। So welcome Ankit ji.
Thank you Vijay ji. Thank you so much.
And in my opinion, he is a much perfect faculty in this specifically valuation field. So कल इनका इंट्रोडक्शन किया था, सर चार्टर्ड अकाउंटेंट हैं, रजिस्टर्ड वैल्यूअर हैं। हमारे चार्टर्ड अकाउंटेंट आरवीओस के अंदर काफी लेक्चर्स दिए हैं, being he is the largest RVO in the field of securities and financial assets, and IOV is the largest in land and building asset class. So Ankit ji, please proceed.
Thank you, thank you so much. And I think start with maybe a deliberation, maybe a discussion, and maybe all of you can start talking about what do we all understand when we talk about a startup. Of course, Vijay ji has started with a very, very brilliant example of Flipkart, something that is something that is seen by or known to everyone. And yes, we know others also. We know Ola, we know Uber, we know other startups also, and we know that they are burning money, they are not earning any profits. And yes, still we still know that yes, occasionally there comes a news that somebody has invested in these stocks or in these shares or in these companies, and they have valued this company at this amount, that amount. The latest one is Jio, where Jio is of course something that is still of course has been loss making, has not been earning any revenue because it has been giving free mobile services for a long time now. But yes, that has also been valued, and we should discuss, all of us, that why do we think somebody finds value in these companies. So let's start that discussion. I would like to all of you to participate, and maybe the participants who have their cameras switched off can attempt to switch on their cameras. It will be a very, very interactive session that ways. And let us make this a learning that everyone can have. All the questions, I always say that one question asked by one person is basically also the question asked by the question in the mind of everyone else. So when you ask a question, you're basically contributing to everyone's learning by asking the question that might be in other people's mind, but they might not be asking it. So I think you can start, and I think I can try and understand what we all understand from startups. And I will also like to understand at the same time, what questions with respect to valuation of startups do you have in your mind, which I will like to answer during the session. Anyone who will like to start? Anyone who will like to contribute first?
Hi, this is Supraja Natarajan. So since nobody is speaking up, I thought I'll speak up.
Yes, Supraja, please.
So my question is very simple. So I am also a chartered accountant, and I try to help entities in performing better. Okay, that's what I do.
Okay.
So one case, in fact, multiple cases come to me. One was interesting. So it said, I have a fantastic idea. So this young boy who's just out of college, who has done a project on an electric bike. It's something which is the world is talking about now, moving to electric vehicles. Okay, so as an idea, looks very promising, and he's also done a project and he's won an award also for that particular project. So somebody like him, what valuation will he have? How will he get funding? So that kind of question I had.
I will talk about that during my session, sir.
Yes,
and
yes.
I think that's a very, very interesting startup, and I think it's a very heavily technology development, technology dependent or new technology startup that you're talking about. Some which is still not seen actively being pursued in the market. It's pursued, but it is not actually something that is yielding a result on the road, at least when we look at vehicles flying on the road. So yes, I think, but this everyone believes that the time for electric vehicles has come, and there are some technological challenges that are there in that industry. I will briefly talk about that, and then we'll talk about how it might make sense for somebody to invest in this kind of a company, and we will talk about it, sir.
Yeah, great if we can cover that. Yeah.
Yes, yes,
One more thing, Ankit, what we
yes,
face
Ankush.
normally in valuations is for startups, generally the company has just incorporated, and like Mr. Natarajan said, that they have an idea, and on that idea basis they give projections in crores and multiple numbers for which there is no history, no verification.
Right.
So how do we handle that in practical scenario?
We will talk about that. So we will talk about various methods which are available for a newly started startup, and where there is no historical data, where there is no performance, there is no certainty of the future of that startup, whether it will result into some revenue, some cash flows in the future. We will talk about it. We will talk about the perception that an investor has with respect to such a startup, and how we can value the same entity using that perception, understanding that perception. So any other views before I think I will ask some questions to all of you, and maybe that will then further add to our conversation.
Good afternoon. I'm Narayan Gutti.
Yes, Mr. Murthy.
Ankit, this is Sharad.
Yes, I think Mr.
Okay.
Sharaji, you start first, and then Mr. Murthy, your voice was not very audible. Maybe then you can speak up after Mr. Sharad.
Yeah. So I don't know whether Ankit, would you be covering the regulatory requirements for valuation of a startup like FAMA or Companies Act or?
I'll briefly talk about it, and in
Okay.
case there is any question on it, I will expand on it. I have that slide, and I will talk about wherever startups need any valuation and what are the requirements under those rules. I will talk
Sure.
about that.
Thank you. Yeah, I'm Narayan Kutti from Kerala, Plant and
Yes, Mr.
Machinery
Kandar.
Valuer.
Yes, sir.
I would like to know that because whenever a startup is being started, the risk levels for that startup is different. Some of the startups may be very stable ground. Some may be highly risky. How do we
Right, sir.
differentiate that and value that?
Very interesting, sir. So you'll talk about the stages of startup, how the startup is at different stages of its life. So a business can always be at different stages of starting up. So one business can only be an idea. The other business might not have any historical revenue, but the revenue might be expected very soon. And there are also startups which have a revenue trail, which have a business model, which have something going on for which they want to expand suddenly. So we'll talk about these three scenarios. We will also talk about how the risk perception changes based on each and every stage. So when we talk about a startup, we primarily talking about a business wherein the business idea is supposed to be fueled by capital which is sourced from investors. I think everyone will agree with me that when we talk about a startup, we rarely talk about a brick and mortar model where we say that, okay, I will start a business. I have my capital. I will put in my capital. I have a collateral. I have a house property. I have a house. I will put that as collateral. I will take some loan. I will then use that loan to drive my business and, create a business, maybe create a manufacturing facility, something like that. And then start manufacturing goods, start doing some production, then make it, scale it up based on the capital available with me and the capital available from the bank. And then slowly my business will take a step, slowly it will get reputation, and slowly it will become a bigger business with time, as and when I introduce new products, introduce new machinery, introduce new factories whenever I am done with my capacity. So this is something called a brick and mortar, the old story, or the historical system of doing business, that you have your own capital, or you come together with other people and then you have combined capital, you invest it into a business and then start making a business out of it. I think all of us are professionals, so we know that yes, at some point in time when any of us wanted to start start our practice, there was a thought process that, okay, I will have this kind of a capital expenditure to start my practice. This is the initial money that I will start earning every month when I will start my practice, and this is how it will result into my payment of salaries. A very, I'm talking about a professional model. But as you go deeper, as you look into a manufacturing concern, or you look at maybe various clients of yours who are into some business which is fueled, and which is basically where the capital is sourced from a company, from an international MNC, from an MNC, from a bigger group, from a small entity, also from an MSME enterprise, you will see that the model is very clear, that there is a capital belonging to a promoter. There is somebody who comes in, some banker who supports that promoter, and then there is a business. What does a startup do? Like, I think one of the first startups that we all see every day in day-to-day life is Google. How did Google start? If anyone can contribute on that, how do you think Google started, and what do you think Google did in its first initial years? So what is the major source of revenue for Google? I think that's a question that everyone will be able to answer. So what is the major source? Ads from which place?
Search engine.
Ads from their search engine. So what do they do in the search engine? They say that, okay, if you give us money, when somebody searches online for something, we will put you out in the top, right? That is what they do. That is what they take money for. So how did it start? Like, did they start taking money from the day one? So if you study, you will find out that Google first created that search engine, first optimized that search engine, made sure that the search engine has adequate number of followers. So there was competition at that point in time. There was Yahoo, there was Netscape, there was Microsoft. They were all competing for the search engine space, that, we will provide a search. Everyone was trying to provide a search engine facility that will give the most adequate or most related result to what people want to search for. So in case you search for, maybe, at that point in time, you might have searched for eateries in Delhi. You may not have found as many results you will find today, because today, the internet system in India has also evolved rapidly. But had you just searched for some word like an animal's name, a name of a vegetable, you would have found some article which would have given you information with respect to what that is. And then the idea behind that was that once somebody searches for that thing, and somebody, say, wants to buy that thing. So today, if you do that on Google, if you search for a vegetable, Google will also show you shopping options, that where can you shop it from. So Google will also show you some advertisements of some branded vegetable stores or branded vegetable sites. So how did it start? It started with a PE investment. It started with a VC investment, where somebody came out with an idea that this is a space where we can create an edge. Let us invest. What was the investment required in? The investment was required in massive servers. The investment was required in salaries for the softwares who will be designing the software which was supposed to track the web for the pages. And the expenditure was required to market. At that point in time also, Google perhaps must have spent some money to acquire customers. So this is called a customer acquisition cost. And that is where the people started getting hooked to Google. And today, today we have a situation where Google is a listed company. Google is a very, very extremely valued company, and Google keeps exploring new ways of providing the same service that they did for a normal search engine. Now they have a location search, now they have a shopping search, now they have an image search. So they have done all that. So today, these days, what Google is doing is Google is advertising on YouTube. What is it advertising about? It is advertising about the fact that you don't need to go to Amazon or Flipkart to shop. You should first search for what you want to shop on Google. Why? Because Google will give you results from all the websites and give you perhaps the cheapest price that is available across all the websites. So like again, there is an attempt to have you come to their website and look for shopping websites rather than going directly to Amazon or Flipkart or whatever you use. So I think everyone understands that how was this business model separate from a brick and mortar model? The model was different because there was no revenue, or there was minimal revenue in the beginning. There was an investment phase. where somebody was trying to invest a lot of money to create an idea, to implement an idea, so that that idea can start revenue in future. So what are we looking at? We're looking at a possibility. Whenever we look at a startup, you're looking at a possibility where if somebody invests higher amounts today, there's a possibility to create a niche in a market, possibility to create a monopoly in a market, possibility to create an edge in the market, survive that time, and then once you have taken up that market share, then you can retain it, then you can convert it into revenue. So something very similar happened to WhatsApp, where WhatsApp for a long time had no revenue. It was only a kharcha. It was only an expenditure where somebody is maintaining those servers, somebody is keeping all the data that you have on your phone, somebody is keeping all the file data that you've recently shared so that you can download that from the web, and somebody is giving you live service that within seconds, within milliseconds, your WhatsApp message will reach the other person. But what is the revenue? Are you giving any revenue to WhatsApp? Anyone who can share, what do you think are you contributing to WhatsApp by using WhatsApp? How are you valuable to WhatsApp, and how will WhatsApp earn money out of the WhatsApping that is done by you as a user?
We are providing data.
You're providing data, okay, and
Data, as well as we also provide them the information about what we are talking about, what things
right,
we are talking about.
right.
WhatsApp is
And
also giving commercial services as well. जो भी हम मेक माई ट्रिप या किसी भी कमर्शियल वेबसाइट्स के थ्रू कुछ बुक कराते हैं या इंश्योरेंस कंपनी से, वो वेरीफाइड नंबर से इमीडिएटली हमारे पास ईमेल के साथ साथ व्हाट्सएप पे भी हमारे पास इंश्योरेंस कॉपी या एयरलाइन टिकट्स आ जाती है, बाकायदा उसके ऊपर नाम लिखा होता है बिजनेस अकाउंट, और ये ऑटोमेटिक सिस्टम कमर्शियल सर्विस व्हाट्सएप दे रहा है.
So there's a WhatsApp for business, for which WhatsApp charges businesses for WhatsApp messages sent to people. So WhatsApp is one of the companies which says that we have so much data, we know so much about the people who are using our WhatsApp. So there's somebody will say that, okay, if you're a valuer, say, let me give an example of something that we are interested in. If you're a valuer and you're interested in reaching out and telling people who are using valuation services to and introduce yourself to them. So WhatsApp today says that, okay, we will help you figure out that what data or what audience is your target audience, and yes, you can send a message straight to them and introduce yourself, tell them that about what you're doing. So what is WhatsApp offering a business user? It is offering messages sent from an unknown number to you. You would know that WhatsApp otherwise says that, okay, anyone can send a message to anyone, but if you want to broadcast, then the broadcast will go to those numbers only if from a personal WhatsApp, it will go only to those numbers which have your number saved. So in case you want to send a WhatsApp message in bulk to maybe 1,000 people in Delhi or in India who you think who you have targeted and who you think are consumers for valuation services, then you can create those complex filters on Facebook, WhatsApp, and then send that message across to those numbers in bulk where those people have perhaps not saved your number. So this is the power of WhatsApp today. This is what they're trying to commercialize on WhatsApp. Other than that, the data itself is valuable. But the data is not there to provide it to a government or something like that. The data is supposed to be used to profile you. The data is supposed to be used to target advertisements to you. So at a future date, so in case any of you are using Instagram, you will see that when you go through Instagram these days, if you have your friends or if your connections posting some images, posting some things, then those images will always be coupled with certain ads coming in from businesses, where those businesses are trying to target you to maybe shop for a clothing, shop for a shoe, shop for something that you have searched online. So that is what they have done. They have created something, they have made people hook on to something, and then they are now trying to monetize it. So some investor at some point in time gave funds to WhatsApp promoters and said that you create this business, your idea is very good, it will give us a lot of monopoly, lot of data, and you will be able to capture this market, and then we will monetize it. So somebody at some point in time said, okay, I will invest 100 rupees today, and I know that you will be able to create cash flows to the equivalent of 1,000 rupees, maybe 5 years down the line, maybe 10 years down the line. So that thought process created that idea that somebody will invest, and somebody will invest, and the investment idea is that at a future date there will be a realizable value which is much higher. What happened with WhatsApp is also very, very interesting. When WhatsApp was sold or purchased by Facebook, the value perhaps given by Facebook was not only for the income generating capability of WhatsApp. The value given was also so that some other competitor should not buy it and use it against the market created by Facebook. So at several times, you also find a market like that. So when you see Flipkart sale to Walmart, you will see that there was an opportunity for somebody to acquire a setup online business and then expand it at a later date with their own effort and with their effort and energy. And that was the logic behind the purchase by Walmart, that they got an entry into such a big market like India through this route, where they had tried a physical store wise entry within JV with Airtel much earlier. So I think all of you understand that. Any other examples of startups that you would like me to talk about? What do I think about them before I share my screen and start my presentation? So I think I will start, and I will start with the, just a second. Yeah. So I'll start with the need for valuation. I think that was also a question that came up, that whenever there is a when are there regulatory requirements to value a startup? The first requirement comes in when you're doing a private placement or a preferential issue of shares on a preferential basis under section 62(1)(c) of Companies Act. Here, a registered value is required to be appointed, and a registered value is required to give a valuation certificate with respect to the value of share as on the date of that issue of share. And this is one of the requirements. Then there is a requirement to issue whenever somebody issues sweat equity shares under Rule 8 of the company share capital and debenture rules. There also registered value is required to be appointed. I have written this as part of this requirement because frequently sweat equity shares are issued by startups. Sweat equity shares also can also be issued by any company whatsoever. So this is not directly related to startups, but yes, startups do raise a lot of capital, therefore they issue shares frequently. And at the same time, they have people who are working for them, who they sometimes compensate by way of issue of sweat equity shares. That's where these two rules come into place. Then there is a requirement under Income Tax Act under 5627B to compute the fair market value of these shares issued by a company in which public is not substantially interested. So the Income Tax Act says that in case a company is issuing fresh shares and that company is not a publicly listed company, then how do you value those shares? So it says that why was it introduced? It was basically introduced to say that if a share is issued by the company at its face value, then that share is not supposed to be valued. Then that face value is perfectly good. But if somebody is valuing a share and somebody is allotting a share at maybe 1,000 rupees, so 1,000 rupees comprising of 10 rupees of face value and 990 rupees of premium. So in that case, it becomes important for the income tax department to understand that that share was actually worth that much. And it says that in case that share is not worth that much, then we will like to tax the company for the money that has been received by it from that shareholder, because the company has received money in excess of the share, the value, fair market value of the share in the company. That is the premise on which they want to tax it. So for that, they need to understand what is the FMV. There are 2-3 methods of computing FMV here. One method is to simply look at the book value. If the book value is not giving you any result, then you have a possibility to compute discounted value based on DCF. Income tax department does not allow you to use any other method apart from DCF. It says you have to use DCF. Whereas for issue of shares under preferential basis under Companies Act for sweat equity shares, you can always issue other methods other than DCF. But if you want to do a valuation under income tax for the purpose of FMV computation, you have to follow DCF. Issue of capital instruments to a person resident outside India. So this is under FEMA. under FEMA, there is a requirement that in case a company is issuing shares to somebody who is abroad, somebody who is a non-resident, somebody who is not present in India, then the RBI says that you need to check whether that share allotment is happening at fair price or not. So in case the company's fair value, fair price is say 100 rupees, RBI says that we will not allow anyone to issue that share at 50 rupees to the shareholder abroad, because that will result in dilution or dilution of the capital in the Indian entity, or transfer of money, or transfer of a higher share to people who are abroad, and they want to therefore protect it. So that's why they say that okay, if the share is valued 100 rupees by a chartered accountant, merchant banker, or a practicing cost accountant, in that case we will allow you to invest at 100 rupees or higher than 100 rupees, but not less than that. That is the basis of this requirement. Then, of course, there are other requirements, advisory services to investee companies, investors, funds, promoters. So this startup world is very, very huge. There are many people who are promoters, but who are not yet startups, who will like to become a startup, who will like to get some investment from somebody, from an investor, and they will come to a chartered accountant, come to a consultant, take feedback on what they can get, what is in their, what should they ask for. So one of the first things that happens, and whenever a company or whenever a promoter goes to somebody, goes to an investor and says that okay, I want money from you, please invest in my company, one of the first things that starts with is what do you think is the value of your company? That is asked by the investor. And then he says that okay, what percentage of share do you want to give me, or what value do you want to be invested? So these are the first questions that are asked. And basically the idea is, if you go to an investor and say that okay, I want to expand my business idea is this, or my business is running and that business is this, and I want to expand my business rapidly, you give me money and I will make sure that this money increases rapidly. Then the investor asks that okay, how much are you expecting, how will you spend it, and what is the value of the company that you want me to believe in, and then how will you give me an exit? All that is asked by the investor. Any questions on this regulatory requirement part from anyone?
Yeah, Ankit, this is Sharad. So
Yes, Sharad.
this section 56 to 7B, this does not apply if the investor is a foreign entity. Okay.
Yes, this only applies to a resident entity.
It's only for resident.
A resident who is not a registered venture capital entity, or which is not a, where the company is not a registered startup with the DPIIT. That is the definition.
Right. And one more question I had regarding this slide is that sweat equity shares, it's covered under the Rule 8 of the company's rules.
Mhm.
But sometimes startup issues shares to investors or to a person who is not even the employee. So sweat equity shares are generally issued to the employees, but just to the promoter or the investor. So will that be covered by this Rule 8 sweat equity shares?
So I am not aware of shares being issued to an investor without consideration. Does that happen? Like, have you seen that happening anywhere?
Yeah,
I think that is what you're suggesting.
no, it's not a suggestion. In a conversation with the startup recently, I heard that they were inquiring whether we can do that without consideration. Yes.
So one reason why that is done is where, what happens is that, I will tell you a little about this. So what happens is that whenever an investor invests in a company, there is normally a foreseeable future that the investor believes in. And the investor says that, okay, I will buy a 20% share. And that 20% share is based on these promises made by you. And if the promises are not fulfilled by the promoter, that kind of growth does not happen in the company. In some circumstances, there is a possibility of a variation, future variation in the effective value of the company. So the investor says that, okay, the promoter is the best person who knows how much the company can grow. And therefore, let me believe that if the promoter says that he can take a company's value from 10 crores to 100 crores within a year, then I will believe it. But if the promoter is not able to take it to 100 crores, say he's only able to take it to 50 crores, then there is a clause normally which investors put in, where they say that in case the value does not increase to that margin that you have promised, then our share will increase. So in most circumstances, the share increases by way of convertibility from preference shares to equity shares. In some cases where that convertibility is not something that is happening, there might be a requirement for a promoter to try and give shares without consideration or at a less consideration to the investors. So this might be more of an exception. In normal circumstances, what happens is that the convertibility from preference shares to equity shares takes care of this requirement. So if there is no other question, I will move forward.
I have a question,
Yes, sir.
Ankit sir. In relation to a chartered accountant certificate issued in relation to issue of capital instruments to a person resident outside India, is there any limit prescribed under FEMA that until this limit only a CA certificate is valid, and above that only a merchant banker certificate is valid?
No,
So
I
there's
don't
no
think
limitation.
so. I don't think so. No,
Okay.
I've not read anything like that. But what normally happens is that in some cases, what I've seen is that the investment is happening from a foreign person as well as from a Indian entity at the same in the same round. So when that happens, there is a requirement that under income tax is a requirement to get a merchant banker certificate. So normally when the merchant banker gives that certificate, it meets both purposes of FEMA as well as income tax. So this is one thing that happens mostly.
All right, thank you.
So we have already briefly talked about it. There are these various names to an investor. Some people are called angel investors. Some people are called private equity investors. Some people are called venture capital investors. So what are these funds? Like anyone who understands what are angels, PEs, VCs, uh, who are these people who try to invest in startups in India? Anyone who would like to contribute to that?
Like these are large fund guys actually, and who like to take basically they pool their resources, like they invest in say 50 such ventures, and out of which, even if 4 or 5 also are successful, WhatsApp, and WhatsApp is today now billions. So this kind of investors are having this kind of characteristics basically.
So absolutely right, sir. Mr. Roy, you have very elaborately and done a very good job in defining what these people are. I will just extend it. So what these people are normally these people are investors. These people are, individual investors who have given their money to a fund manager. So normally there is a system of a LP and a GP. LP is a limited partner. Limited partners are those people who have given the money to a fund or contributed to a fund. So basically, it's like a partnership. It's like an LLP. It's like a fund created together. So 10 people, 20 people, 25, 30 people, they say that, okay, we believe that maybe, this bank or this investment banker has done a great job in the past in finding opportunities for our money to be invested. So what they do is maybe 10%, 20%, somebody might look into a higher amount, but this is extremely high risk capital that they put in. They say that, okay, if I have 100 rupees today, let me try and invest up to maybe 10, 20 rupees out of that 100 rupees that I own as on date into this kind of a fund. And then when they put that money into a fund, that fund basically then collects maybe 1 million from this place, 1 million from this place, and then has a maybe 20 people contributing, so has a corpus then of maybe $20 million or something like that. Then that fund is in the market. That fund is watching out for opportunities, watching out for options available for it to invest. And then that high risk capital then goes into the companies. And then sometimes these are when we talk about VCs, these are venture capital funds, where these are larger organizations. Private equity is normally somebody who is basically starting out with the fund. So somebody who will maybe a very rich promoter of a company says that, okay, I earn maybe that person owns crazy money every month, and he says that, okay, part of the money I want to invest in new funds. So like promoters like promoters of Dabur say, or promoters of maybe the Ambanis, maybe other people, maybe Ratan Tata. You must have heard about him investing in quite a few companies. So these are people who will then try to set up their own private funds and then put money through their private equity investments. Warren Buffett is a very good example, interesting example, where he has also invested in various companies in the past in that model through his entity. Angels are again people who are maybe working in a company but have some money, have some capital with them, and they will talk to a promoter and say that, okay, you have this extremely brilliant idea, I will give you some seed fund, I will give you some basic money that you can convert this idea into some implementable business model, you can work on it. So somebody says that, okay, I have the capability, I have the technology to, as sir mentioned, to create a electric bike. So what does it require to attract attention? It requires maybe a prototype to be created. So when an angel investor comes in, that angel investor will say that, okay, I will give you money. How much do you need to create a prototype for whatever you want to make? So that person will say, maybe I need a crore rupees. Okay, so here is your crore rupees. Here is your 50 lakh rupees. You create this prototype and then show it to me. Let us see what you got, what you have. So somebody will try and put in that money to create a workable model from a stage where that was merely an idea. And that angel can be belonging to the same industry, maybe from a different industry, maybe that angel has a rich experience to add to the promoter's conduct, to the promoter selling off. So if the promoter is a college graduate, and the promoter is extremely skillful in some technical skill, maybe he is a very very good engineer and he wants to create this motor vehicle or this motorbike, electric motorbike. So what does he miss, what is he missing in his whole capacity? He has a technical skill to create it, but he doesn't have the money to hire people under him. He maybe doesn't have the money to buy parts to build that prototype. Maybe he doesn't even have the money to create a distribution network that will be required to monetize that kind of electric vehicle business. So all that is required. So it starts with an angel, progresses to a PE, then a VC comes in, then maybe at a later stage somebody will acquire that business and say that, okay, we'll give you value, and then you exit the business or you become part of the business. So Times of India has done various deals like that. Dine Out is a product of theirs. Gourmet Passport is a product of theirs, where these were entities or these were businesses started by somebody, and then these businesses were taken over by them in acquisition, and they had and almost in all those models they had given opportunities to the original promoters to work with them, with the capital that they had, with the deep pockets that they had, and make that business more worthy, or widely circulated or publicized. So these are the people who invest. I think we have to cover that. Then there's a fund life. So these people who invest are normally investing for a life. So this fund does not have eternity to live on. So this fund is normally created for maybe 5 years, 7 years, 10 years. These are the normal age of this fund. So the fund collects money at some point in time. It's supposed to deploy that money, and that money is supposed to be then withdrawn and given back to the people. So the fund is basically looking at a life. So what I'm trying to say is that because the fund has a life, the fund is always interested in exiting the investment and moving on to something else. So there also is a possibility that one entity creates a fund, and then it creates another fund after some time, and the second fund takes over from the first fund. But in many cases, there's a fund life, fixed fund life, and that fund is expected to liquidate all its investments at the end of the life. Why is that important? That is important because that creates a requirement that wherever a VC, PE, angel invests money into a business, they're looking at an exit. They want to know that, okay, at some point in time in future we should be able to exit this business and do something else, or return the money to our investors. The idea is not to stay invested for the long term. The idea is to invest, earn money, and then get out. That is the basic idea, because it's the end of the day an investment. It's a short term it's a 5 to 7, 5 to 10 years of investment that everyone is looking at, and that is what they are targeting. They're not targeting to become promoters of a company. They are merely investors who are there to increase their corpus, and they are looking at achieving success through earning high rate of return for their investors. So basically some PE VC funds are sovereign funds. Some of these funds are also funds which have a social thought process, that they want to invest in social impact businesses. So you will find several funds globally which are having a mandate that they should invest in social projects. Like you will find people who want to invest only in building up water capacity, or I should say rather water capacity, I should say, maybe drinking water capacity in India. Somebody will say, I have a project where I will be able to, certainly I have a technology wherein I will be able to refine and distribute much more drinking water as compared to what can be done today based on the technologies available today. So that person will perhaps get an interest from a fund which is having a social impact thought process, and then that fund will invest money. Similarly, one of the businesses that we consult for is into the business of skill development. And they say that, okay, skill development is a very, very interesting game. Anyone who introduces technology to make skill development better, introduce better skills to the population of India, they want to invest in that because that has a social impact. Because their investors say that, okay, we are investing this money with you, but we also want you to create to have interest or have this much percentage of the total funds that you deploy into social impact businesses, so that we also not only create profits for ourselves, we also create a better society. So the philanthropy thought process is there. Key elements of an investment decision in any startup is, one looks at the quality of management, one looks at the scope for rapid expansion with capital. So in case you talk about a business which will slowly increase, in case somebody tells you today that, okay, I am an investor, I want to invest in your CA practice, I will give you $1 million, you spend that money and increase your business to 10 times, your professional income to 10 times within 1 year. Anyone here who thinks that that can be done? That investment of money into a CA practice can increase it to 10 times or 100 times in a year? Maybe not. Maybe not, because it's not something that a professional practice does not grow with money alone. You have to put in effort, you have to have an organic growth process. But there can be other businesses which can suddenly grow with money being put in. So say, assuming that okay, somebody is into the business of maybe skin or hair, and that person says that, okay, I have maybe 2 clinics in Delhi, and whenever I will earn good money, I will be and I have that money with me, I will then like to invest that money into a third clinic. And then when I open a third clinic or a fourth clinic, or I open a clinic outside Delhi, then I will suddenly start increasing my revenue. So that or increase my cash flows. Now that thought process is something that perhaps can be where rapid expansion can happen with money. In case somebody says, you leave the break even, you just open new clinics, and we will finance the idea that you will we will finance the process of your expansion till the time you have this many clinics. And then when the revenue increases, or when revenue increases rapidly, then we will understand that yes, the business has created some real real presence in the markets that it went to. Any questions on this?
Yeah, can you just give me 1 or 2 points on what the PE or investor will look at when you say quality of management?
The PE or the investor will say will is basically not somebody who wants to sit on the driver's seat of the company. The investor is supposed to sit on the backside. He wants to sit in the bus, but on the backside. The driver is what the promoter will be. And the PE can always, the PE angel VC can always have controls to monitor the conduct of the promoter, to make sure that he is doing what he promised to do. He is putting in adequate time. There are KPIs, key performance indicators, that the promoter is given. The promoter is required to follow and expand with the promoter kind of commits. So the investors are looking at the investor or the management from the point of view that they want that management to be responsible enough, or learned enough or experienced enough to take that business forward to that next level. At any point in time, in case they feel that the promoter is not equipped to do the expansion, that rapid expansion that they're expecting the promoter to do, then they will not have faith in the whole idea that this man. So basically, the investor is putting money behind a man, or behind a couple of men, and those men or those people need to perform. So when you look at those capability of that management, that is what is looked at very closely by the investor. That is why you will hear things like a pitch deck to be prepared by the investors, the investor, the promote by the promoters making a pitch to the investors that, okay, this is my business model. So the promoter in that process also says that why is he equipped enough, or why is he capable to do that business. So maybe when Mark Zuckerberg went to an investor, when he had the Facebook idea, he had a prototype which was perhaps working in the college that he had, or he had a friend who invested in that business at that point in time. So at that point in time, perhaps somebody trusted that this man can take this business forward to the next level. And maybe with some support, maybe with some management, but the chairperson, but the driver of that business was one. It was not multiple people. So normally that person is very, very important.
Okay.
So what are the typical characteristics of a startup business when we come to valuation, or these are also limitations, or these are challenges, I can say, for a startup business when we talk about how we want to value them. So there is almost no or minimal historical data which is available, or frequently the historical data is very different from what are the projections, what projections are. So this is one challenge that is there. I will also talk about how I normally address this challenge. Then you look at untested products not having an established market. So somebody, as you said, an electric motor vehicle, motorbike, is something which perhaps is an untested product. You don't know how many people will buy it. You don't know how many people will be interested in that. Does not have any market. Charging stations are still coming up in India. You don't have too many charging stations. There are still so many things that people have in mind. There is still this doubt on what will be the cost of battery replacement after 3-4 years, when you are, when you have run that electric vehicle or electric bike for this many years. The cost is a prohibition. So all that is there. Absence of comparable firms might be a problem today. If you want to value a company which is manufacturing electric bikes, it will be difficult for you to find a comparable in the same industry, because that industry does not exist as on date. So that is a big problem. Then the value of entity relies entirely on its future growth. So like future growth is something which is an unpredictable number. The growth can be 20%, the growth can be 25, the growth can be 30. COVID happened, maybe there is a negative growth because of that, maybe everything shut down. So that's what basically the entity relies. The value of the entity is heavily dependent on the future growth, and that future growth is not something which is guaranteed because of the existence of a market, acceptability of a product. So that becomes a problem. Then the normally very high future growth is estimated based upon assessment of competence of existing managers and their capacity to convert a promising idea into a commercial success. Many don't survive the test of time. So somebody says that, okay, startups have a very high very high growth rate, and it is something that has been seen in so many successful startups. Why don't you just assume that this startup will also be big? Then the other person normally counters this claim and says that many startups don't test time, because they just finish off. If you look at the hotel industry, there were so many businesses in India which were competing with Oyo at one point in time in the hotel marketplace industry, and they all lost out. They all just, the money that was invested in those businesses is lost for the investors. Similarly, look at maybe examples like Snapdeal. What happened to Snapdeal was at a very advanced stage, but there were other businesses similar to that business where the business just didn't survive. It just vanished. So that is basically a problem that you face in startup valuations. then there are various claims on value. The investor will say that I don't see this company valued at more than this price. The investee or the promoter will say, no, my company is very, very valuable, and he will always say that I will do this performance. So there's the achievable performance and the actual performance, or the achievable performance as per the promoter and the achievable performance as per the investor might be very, very different. So that is what you need to look into. That is what is a challenge that you face in startup valuations. Then investments have very, very limited liquidity. So basically, when you make an investment in any startup business, you are always thinking that, okay, you are assuming a lot to say that this business or this investment will go back after some time. So the investments are mostly not liquid. So in case you are investing into maybe an electric motor vehicle, electric motorbike business, then that investment will give returns maybe after many years. In case somebody is going on investing into that entity, some businesses like Uber, some businesses like Amazon, Flipkart are still in the red. So they're still not making enough money even today, after so many years of their existence. Look at Amazon also, Amazon Prime, Amazon. They have also, basically, they are into the data business, the cloud storage business. They are also they are also of course converting their business into, or trying to make that a profitable business, but they are also having too many businesses where those businesses are into their investment phase, and where they are going through a lot. So whenever you're doing a valuation of a startup business, you look at believability, reasonability of the business plan. You look at that. You look at how venture capitalists assess the value of the firms, and then you must know that you should know that this you should briefly understand about this industry, at how do investors value that firm, so that you can also have their perspective and then share that. One of the things I say is that you always have to, as valuers, try to assess the market, try to assess that what will be the value of this share, what will be the value of this business when it is put into tested to the market. That is what you're competing against to give a value. So when you're competing against the market, it is important that you assess, or you should know that what is the market. If some promoter goes today to the market and says that, okay, I want money for my shares in the company, or for some investment in the company, you have to know the other side of it, so that you also know that what will be the thought process of the investor before that investor puts money into that company, so that you can understand the demand supply factors and then assess the value based on your independent opinion. There's a venture capital method. We will talk about it. I think it is mentioned here, but let's talk about it later when we come to that slide. Knowledge about growth trends for new business industry. You should know about what are the growth trends, how much have businesses grown in the past, what have been the basis of transactions in the past, so that you can predict the future better. A rough estimate of dilution acceptable by founders. So you should know that, okay, founders, how much are they willing to dilute, because that will also have a bearing on the value of the entity, value of the business. A very, very interesting chart talking about how a startup kind of goes through time, where it is a pre-startup, then it becomes a startup, and then the startup group phase, and then the growth phase. So in like it starts in pre-startup phase. It is ideation, concepting, and then commitment. So once the commitment happens, then there's a validation, there's a scaling that happens, and then when the company or the end business grows, then there is an establishing that happens. So there is always this growth. So the growth keeps increasing with time, and then there's a vision and mission, there's a minimum viable product, there's a product market fit, and then there is a scale that is given to the overall concept that is being implemented. What is important is what we are writing under this chart, under this image, and that is that in conceptualization stage, I should say, the process is for ideation, concept, pilot tested, and then you see the gap in the market, and you kind of see that, okay, I see that there will be some requirement for the product that I want to introduce, because my product is offering this differentiation. So when somebody says that, okay, why are you investing your time in creating an electric bike business? because one says that electric bike business is the future. Why? Because it is something that governments will promote. Maybe it is emission free. Maybe it is something that will make travel cheaper. Maybe it will be something which adds adds a lot of incremental value or replacement to the existing thought process. Maybe those electrical vehicles will also be cheaper in the long run. So we'll think all that and say that, okay, because of all those things, I think that this will be a great idea. Then there is a pre-series A stage where you say that, okay, what is the you do what is that stage where the market is tested, the sales are in place, distribution for at least one market is set up. So I say that, okay, I want to I say that I want to do a business of sale of maybe meat or fish in Delhi. And I say that, okay, I have created a market, I have created brand presence, people now know me, people now know that yes, I do a good service, I deliver on time, I deliver good quality products, and therefore people are buying from me in Delhi. And then maybe you have so far created a business model from your own money, but in future you might have a thought process to expand to different cities across India. And to do that, you have to then look at the possibilities of how will you do that. You will most probably raise money as a pre-series A startup, and then you will try to expand your business to other cities, because when you expand your business to other cities, you have to create logistics, appropriate logistics, you have to create appropriate you have to hire the adequate number of people, you have to have that kind of working capital to buy those items. So all that becomes very, very important. Series A, B, C, D, and these are stages which happen when during these series there is an established sale in one market. There's a manufacturing setup that might be required. So some examples of these are that Soruchi was a smart LED lamp started by an ex-Philips MD. So basically, they then raised money from Sequoia. Pre-series A stage where an online fresh meat company raised 20 crores from Sitbi VC and Amit Burman. Series A, B, and A, B, C, and D startups where Flipkart raised several rounds of capital, or Urban Clap raising capital. All that is something that happen that has these are examples of these various stages of a startup. Any questions on this slide?
Yes, sir. One question here.
Mhm.
You have this conceptualization stage and the pre-series stage, pre-series
Mhm.
A stage. So my question is the funding raised during the conceptualization stage also as well as pre-series A stage, or it starts from pre-series A stage?
It will totally depend on the promoter. If the promoter feels that he doesn't want to dilute his share, he has an opportunity to grow the business to a reasonable pre-series A stage on his own, then the promoter will do that. But if the promoter is a student in IIT, in an IIT or in an engineering college, he gets an idea and he has no money of his own, then the promoter will most probably approach an angel, promote a person who will finance finance the idea of creating something and then taking it forward. I think most of you must have seen Social Network, or you must be knowing Facebook's growth story. So do you think that conceptualization stage, when Facebook launched that Facebook website for the college, was that conceptualization stage, or was that a pre-series A stage when he borrowed money from his friend or took an investment from his friend?
It was prototype, I mean,
I
conceptualization.
think it was conceptualization, in my
Yeah, yeah.
opinion. So I think that is a very live example that I think is a house to day house to house example of how a college student got an idea and then took it forward based on his understanding of based on the capital available from another person who had capital to contribute.
So, sir, like our valuation at the conceptualization stage and the valuation at the pre-series A stage. Suppose a model fails, say at a later stage. Suppose you are increasing the scale, say scale of operation in region or
Hmm.
market, whatever. So the valuation has to happen at all the stages. Am I is my understanding correct? Like
Valuation has to happen on the date of the valuation, sir. So in case you're valuing the business at a particular date, you have to value it as on date. Or if as on that date you feel that yes, the business has an idea, the business has a concept which is appealing to somebody, there is a value that is seen by somebody in future, then the valuation can happen according to that. We will come to that. We will come at valuation that happens at various stages. I will give you more details of what valuation methods are available at various stages as we go further.
Okay, sir. Okay. Thank you very much.
Any other questions on this sheet, on this slide? Okay, I'll move forward then. So before we look at approaches to valuation startups, let us look at the same, let me answer Mrinalji's question, that when there is a concept stage, a seed funding kind of a round, the key characteristics of that stage is that there are limited or no revenues, there is product is conceptualized, product testing done across few sample customer points. That is normally the stage at which, the concept stage is there. So the investor is normally a bootstrapped or an accelerator or an angel investor. And so bootstrapped is that you use your own money. So you kind of just gather your own resources and then you start using it, or you basically do what you use your own profits to expand your business, to create capital so that you can invest into a bigger item, bigger thing. So valuation approaches are basically raising 50 lakhs to rupees 5 crores. There is no set methodology. Capacity limiting equity dilution at this stage to 10 to 30% is normally the intent. And normally people use a DCF to value the company at this stage, where they say that, okay, the company might be valued at this rupees after 5 years if this becomes a successful model, and then they value it to the present date. This is how normally it is done. Pre-series A stage, revenue traction for last 6 to 12 months at least. Then there's normally a cash burn. Early stage VCs are basically the type of investors who are looking at this kind of a round. Raising rupees 3 crores to 20 to 30 crores is normally seen as what people will be raising. Comparable transaction, DCF, these are the normal methods that are followed to value pre-series A stage companies. Limiting the total dilution at this stage to 30 or so, but less than 49% is the ideal idea. Series A, B, C, all these are then series where there are strong revenues for last 2 years or more. There might be some cash burn which is still going on. The investors who are interested are VCs, private equity, M&A by strategic companies. They are the type of investors who are interested in such startups who are at Series A, B, C, D stage. Then valuation approaches include raising about $5 million or onwards. Comparable transactions, DCF, you look at founders equity to get limited to be limited to 7 to 8%. So this is normally the process during the last rounds in the majority typical majority at Series A funding. So this is what happens. This is the various methods that are adopted. Coming to the methods, these are the some methods that are used for startup valuations. They're Berkus, there's risk factor summation, scorecard, comparable transactions is something that I think is something that is more familiar, should be more familiar to all of you. Book value, liquidation value, discounted cash flow, first Chicago, and venture capital basis. So basically, these are the valuation methods that are normally understood to be that are normally used to value startups. And I believe I will discuss all of them one by one. So in case I miss out on anyone, do let me know. I will just take it forward. So we'll briefly look at IVS 105 and say that what are the valuation approaches that are available for the valuation of these companies using based on the IVS. So we see that the comparable transactions approach is something that is widely used. It is something where you identify a comparable transaction, analyze analysis of qualitative and
Could you
quantitative
please
asset
bring
values.
your mic near? Your voice is good.
I
Yeah,
think it should
it's
be
fine now.
better. Yeah, it
Yeah.
should be better now. So then there is a comparable transaction method. There is guideline publicly traded comparable method. There is a rule of thumb that happens. Then there is a discount of lack of marketability which you apply. Control premium is what you apply, and then blockage discounts is what you apply. There is also income approach which allows for a DCF, and the DCF can have many varieties, can have various assumptions that change. So I think DCF is something that all of us will be more familiar with. But yes, when you do comparable transactions method, guideline, publicly traded comparable method, that will require a lot of research of the industry, of the comparables, and then trying to figure out what is different. We will also talk about these methods as we go along. So in guideline publicly traded comparable method, you normally look at a listed entity and then you say that, okay, what is happening to that stock? What is the total value of that stock? And then you look at the enterprise value of that stock. Pick up a multiple that you feel is relevant, and then based on that multiple, you compute the value of the organization that you want to value. So typically, the factors that are required adjustment that require an adjustment to the value or the multiplication factor that is generated by a publicly traded comparable is that the company that you are valuing might be smaller, it may not be very well capitalized, and it might have a a shorter history, or and it is not a publicly traded stock, so the liquidity is not that much. So this is what is the normal adjustments that you do to a publicly traded comparable whenever you're valuing a startup. Comparable transactions method is something where you look for, so supposedly you want to look for valuing your box. We are calling it a box. So you have a company or a business and then you're trying to value that box. So you look at similar boxes, you look at what were the transactions there for. So this is a comparable transactions method. What is the difference? The difference is that where one, the publicly traded comparable method is a method which is used where the basis of your valuation will be the market price, active market price perhaps of any listed share. But in case of a comparable transaction method, you can look at past transactions that might have happened in the same industry and then try to find out the multiple. So what have we done in this example here? We have seen that what have similar companies or similar boxes been sold for. So we have the amount for which they were sold. We have a revenue multiple that, okay, what was the revenue and what was the revenue multiple based on which the valuation was done. Then you have a VOU multiple, WAU here is weekly active users. So basically, there is a system in technology companies or in internet companies where you look at DAU, WAU, or MAU. What you do is you look at daily active users. How many people visit your app or your website every day? How many people use your app or website at least once a week? And how many people use your site once in a month? So these are basically the abbreviations that are used. So the WAU multiple is an interesting multiple where, yes, we come to know there that that this company number B, company number 2, has a very perhaps a very high WAU multiple, where maybe the value that they are realizing out of one visit is way more as compared to other companies who are competing for it. So that is what I think. Then what you do is you kind of compute a weighted average and then multiply that weighted average multiple with the indicators of the company that you want to value, and therefore you then get a valuation of the box or of the company that you want to value. That is something that is coming out in the last line here. So any questions on this comparable transactions method?
Sir, excuse me, sir.
Yes, sir.
As you said, sir, startups are generally innovative type business. Like you told, electrical motor bike business. How we can apply comparable transaction method there? Because no comparative available.
So there are possibilities that there is no comparable available. Your technology that you want to start, your technology that you want to develop is having no comparable at all. There's also possibility that multiple people are competing for the same business. So when Snapdeal, Amazon, and Flipkart started online business in India or online shopping in India, do you think that one transaction that might have happened in one company affects the other's valuation?
Yes, maybe.
Right. So at that time, if somebody would have come to you and said that, okay, Flipkart is raising this much money, sir, will you like to value it? So will you be able to refer to other transactions of Flipkart or of Amazon or Snapdeal and say that, okay, other companies have have used this multiple and computed the transaction value. And because Flipkart is having these many weekly active users, I want to give this value to Flipkart.
Maybe compared.
Maybe compared. So basically, comparable transactions are available from many sources, public sources, news items, and then looking at those comparable transactions, you can then kind of create an estimate. So one interesting idea was that when WhatsApp was bought by Facebook, that transaction is understood to be a transaction which can influence many other transactions that happen in future, right? Because maybe somebody will not value at that exact multiple that Facebook paid for WhatsApp, but somebody will definitely be inspired or be directed from that comparable transaction that is available publicly.
Yes, sir.
Any other question on comparable transactions method? Or
So,
this
Ankit ji, for this comparable transaction method, where do we get these multiples? 3x, 3.3x. So where do we get this data?
there are databases online. VC Circle is a very, very interesting database. There are other databases like Capital Line databases where, there are people who track transactions, and then of course they have a subscription that you can pay, and then you can gather this data. You can look for online news on transactions that keep happening. You can keep a watch on Economic Times and make sure that you are updated with the latest investments that are happening in startups in India. What are people willing to buy? So in case you want to perhaps value, maybe today, tomorrow, somebody comes to you and says that, okay, I have a retail chain, retail kirana store chain, and I want you to value it. Do you think you will be able to use the transaction of Geo buying out Future Group?
So
Maybe yes. Maybe yes. Maybe yes. Maybe if the size matches or after some adjustments, you might be able to give a value based on that. So it is. So I will give you a personal experience where we valued a power plant, and we tried to look for market comparables of transactions that have happened, and we found quite a few transactions. Not even going to a paid database, we found them online, and you were able to find out and give a value based on that comparable, and that comparable really helped us in confirming that our DCF was aligned to the market sentiments with respect to the power sector. There is also, before I come to other approaches, I want to talk about, I think I am missing a slide. Give me a second. Yeah. Okay. So cost approach is another option. So IVS 105, I've talked about cost approach, although it is very, very rarely used. But I want everyone to understand that cost approach is also allowed by IVS 105 of the International Valuation Standards to compute the value of a startup entity. And how does it do that? It basically says that it says that wherever you think that the startup it kind of requires an approach where you kind of look at what expense is required to recreate an asset with substantially the same utility as the subject asset. So in case somebody comes to you and says that, okay, I have designed this software, this is an ERP, and this ERP is meant for this market of this industry specifically, and then you want to value that startup. So you might just ask him that, okay, is there any market? Maybe he says there is no market. Is there any revenue? Maybe he says there is no revenue. So in that situation, you might just ask him, okay, if you want to create this software today, maybe you have been working on this software for the last 5 years, 10 years, and then you reached here after so much effort. But if you want to create it today, what is the cost of this kind of an asset or this kind of a software to be created? So that cost perhaps will be the value of that asset, especially where the asset is not expected to or not is not really it's not predictable that how much money it will be making in the future. So you basically then do a replacement cost method. You look at a similar production, reproduction cost, and then you calculate the cost that would be incurred, and then you kind of try and figure out that yes, this is the value that you would like to give to that business. Summation method includes adding the value of each component asset that are part of the subject asset using appropriate valuation method. But this is something that you do primarily where you feel that the startup is destined for liquidation and there may not be any value realizable from the business model that the startup company is trying to create. I just skip this. This is basically depreciation adjustment cost method. So let's come to the scorecard methodology. And before I start this, any questions on this part, cost approach or comparable transactions approach? Any questions? I will also briefly talk about DCF here only. So when you do a DCF, any challenges that you face when you're doing a DCF for a startup, which I might like to, I might try and answer. Anyone?
Yeah, Bob. I would like to share that came across a situation where the startup was on the stage of seed funding, and the VC was investing. The price agreed was 7,800, and 3 years down the line, the company that startup did not go well, and the company closed down. Now we are facing the income tax authorities. So how to defend that DCA value 7,800 at the seed funding stage?
So that's something that has happened to many people. It has happened to us also, where we gave a valuation or one of our clients got a valuation done from a chartered accountant. We are getting their cases scrutinized in income tax. And then, yes, the income tax says that, okay, it says that you projected your financials 3 years back. And those projections were, XXX, and they were projecting maybe that you will have a turnover of 100 crores in 3 years, but your actual turnover today is not even maybe 10 crores. So how do we want to just quash this valuation report that you have got to us, and we want to just want you to pay taxes on it, or rather pay penalty on it because you hid that tax. Because most cases, the tax is not payable at all because of the heavy losses that are there in the startups in most cases. But the penalties are definitely payable, and then you have to go through the appeal process and fight it off. So my interpretation there is that, number one, we need to say that the valuation was done based on DCF because the income tax department believes that DCF is the right way to value it, and there is no other way. They have written DCF. DCF relies upon the perception that what will be the future revenue that comes in, what is the future cash flow that will come in, and that is always an estimate as on the date of the valuation. Nobody is responsible in case that nobody is responsible, not even the valuer, not even the company, in case the projected financial the cash flows do not match the actual cash flows. And that's something that we put on record. Then we try and answer we try and say that there was a reasonable basis for the projections that were thought of or taken. So the valuer is basically required to say that he did a basic analysis or corroborated the revenue figures, and he has not just taken any random number which is unbelievable. So the valuer says that, okay, this was the kind of business model where this money was supposed to be invested, and this was the kind of growth or the basis of the growth in the revenue or the basis of the growth in the profit in the company, and that is what then is shown to the income tax officer. Another thing that we normally do when we look at income tax cases for startup entities is that we say that we see the impact, and then what we normally say is that the investors who invested into the company were all genuine investors. We make it a point to say that, yes, everyone has a pan, all the investors are genuine people, they have sourced this and invested this money based on genuine sources of income in their hands. That also helps us make a case or give the impression that there is no hanky-panky involved in that case. Because when this 7B was first introduced in section 56(2), it was introduced to prevent the idea that there used to be this entry system that used to happen where people used to allot shares at 2 rupees, 10 rupees, and so on. or at higher values to a person and then transfer them at a cheaper price to somebody else. So that was more of a mechanism to convert black money into a usable share capital. So that is what this provision came in for. So that's why we always use that KYC as a protection for us. I hope you got the answer to your question.
Yeah, and can we also think about registering the startup now with DIPP so that they get exemption from the
If it is matching the criteria, obviously everyone will like to get their startup registered. If it is registered now and it was not registered at the time of valuation, I think it will still qualify to be a startup. But then if today we talk about 3-year-old cases, 4-year-old cases, maybe you will have a difficulty in making that firm eligible for a startup registration.
Thanks.
So I will come to scorecard methodology, and the scorecard methodology is like the name is pretty interesting. It simply says that you prepare a scorecard, you identify, you compare the target company to your perception of similar deals done in the industry, considering the strength of the management team, founders' experience, size of the opportunity, where you understand the market size of the company's products or services, the timelines for increase or generation of revenues. Then you look at the product or service, product market definition and fit, and the path to acceptance and barriers to entry. You look at the sales channel, stage of business, size of the investment round, and need for financing and quality of business plan and presentation. Then you give a score in the range of -3 to +3 and multiply these scores with the comparison factor range. So what have we done here in the example is that we have listed down all the comparison factors, including the strength of entrepreneur and team, size of the opportunity, product or service, channel chase sales, and then we have given factors which total up to 100. And then based on that factor, we have multiplied the score. So when somebody says that, okay, there's a -3, then -3 gets multiplied with the range or with the factor that we have for strength of entrepreneur and team, and then that score results into a factor, and that factor is then totaled up to give a result which might help in that factor is what you multiply with your number and then try and get a result. This is what you do. Dave Burker's valuation method involves a very similar approach, but it kind of has a different perspective. Rather than giving a weightage to each and every factor, what you do is you start giving a number. So you say that, okay, it starts with a pre-money valuation of 0 and then assesses the quality of the target company in light of the following characteristics. It will say that, okay, if there's a sound idea, you want to give it any number between 0 to 0.4 million. So in case working prototype is good, so working prototype is good, you will say point. If there is a working prototype at all, then you will give a 0.4 million and you can add it. In case there is no working prototype, maybe you will go back to 0. If the prototype is almost to be developed, maybe you can give a 0.2. So that is how you will give a value to all these characteristics and then add these to the pre-money valuation and try to find out a number that is a number for the valuation of the company, number to assess the valuation of the company. Then there's a risk factor summation method, in which what you do is you give a initial value to the business, and then you say that, okay, if the management risk is low, then you will add a number to the overall risk, and then you can say that, okay, because the management risk is very, very low, I will like to pay more for this company. Similarly, if the stage of the business is normal, you will not make a change. But in case the sale of the stage of the business is in growth phase, then you will add another amount. If the stage of the business is still under conceptual stage, maybe you will subtract something. So similarly, competition risk, if competition risk is very, very high, you subtract something out of the total value because you want to give lesser value in case the field where you are investing money is very competitive. Technology risk, litigation risk, potential lucrative reputation risk, all these are risks then you want to adjust for and then come out with a value for your company. Do ask any questions on these methods whenever you have them, because these are almost all of them are single slide workings. If you want me to repeat something, I can do that. Other approaches include the first. Yes, sir. Your voice is not audible, sir.
As per IVS, it is cost approach, market approach, and income approach. But this comparative methodology is now presented. Is it acceptable as per IVS?
IVS allows for other methodologies, sir. IVS allows for other methodologies. In case you read 105, IVS 105, which talks about the methods of valuation, you will find in the last paras a provision which says that the valuer is free to use any other valuation mechanism which is popularly used in the industry, or which is giving an accurate or a comfortable number to the valuer. So alternative methods are permitted. IVS, the methods that are prescribed by IVS are not exhaustive. It's not an exhaustive list. Any other questions? So the next one is first Chicago method. In first Chicago method, what is done is basically you look at various scenarios. You say that, okay, scenario number one, my company will become $10 million of worth. Scenario number two, that my company will become $70 million worth. Scenario three, that it will become $300 million of worth. And then you multiply that with probability. So the highest probability is that it will become 70 million worth. So in that case, you will put in a probability of 70%. In case you feel that, okay, the chances of the company becoming a $3 million entity is 10%. So you multiply that. So this is the first Chicago method, where you kind of arrive at a number that, okay, the weighted average probability of the company becoming what will the company become after 3 years? Most probably, maybe it will become $81 million of worth. And then you kind of reverse calculate and say that, okay, this is the value that I want from the company, because I'm investing in this many percentage or this many number of shares. Let's do some case studies on some cases that have been done by our firm, and then maybe we will be able to understand better on how do we value these. So this case study one is related to an entity which is offering fresh meat products online, including raw meat, seafood, marinades, cold cuts, and etc. etc. The company has revenues of 8.4 million, and in financial year 17 had revenues of 84 million. So so basically the company is a rapidly growing company. So you can see that from 88.4 million, it has become 84 million. Over an year's time, it has rapidly increased its sales. The distribution network is given to you, that yes, the company has a B2C model where it is sells everything online on online channels. Then under offline channel, it sells stuff. Then it be on B2B channel. Then it has clients including restaurant chains. And then it kind of talks about the size of the market. This is what you will be studying, that yes, what is the total Indian market with respect to the food, the meat products and seafood and all that. What is the Delhi NCR market? You assess that. And then you look at the opportunity that is available. So the Delhi NCR market does not have a large organized player. So it basically kind of gives you a SWOT analysis of the industry, or the strength of the company. So then you look at, you do a comparison chart where you want to arrive at comparable companies' transactions. And then you kind of verify these are different companies where, you understand, okay, where are they based? So they will be, some of these are based in local markets. Some of these are basically have different markets, that sourcing model is different. Some of them have different processing facilities. So therefore you kind of look at all these options, and then kind of have an idea of what is valued what, and what is valued based on what synergy. So basically, if somebody is doing government business and maybe you're not interested in doing government business, you might like to consider the same in the when you're comparing the comparable with the target company value, which you're valuing. The building, then you build a financial model, you look at products, you look at region-wise sales, and then step-wise marketing entry. So everyone, you will not be able to enter everything together. So in case you're presently available in Delhi NCR, maybe it will take some time for you to start Chandigarh, Ludhiana, or Bombay, and therefore you will take some time. And then that should also reflect in your DCF model. So what do? You then look at the detailed financial model, and then you look at online sales, shop-in-shop sales, and B2B sales. So you look at all these projections, all the three different projections independently, so that you have a strong basis to whatever revenue you are targeting. And then when you do the valuation based on these assumptions, you do a DCF, you come out with a value for that, you do a transaction comparable based on the transactions that are available for the same industry. And then maybe you do a weighted average final valuation for pre-money by giving some weight to both these values. So this is one example. This is one case study. Anyone who has any questions on this case study? Any doubt on this case study? Any suggestions which you think that are appropriate for this case study?
Ankitji, in this valuation, you did not consider other methods like Berkeley's for Chicago or the risk summation.
The basic idea behind doing that was that this company is already having an established sale number. So as the example says that in financial year 17 it had a 84 million sale. So it seems that the entity has already created a market. And when an entity has created a market and you're able to figure out that, yes, what is the competition in this market, it is basically easier to rely on DCF as compared to other methods. DCF or market comparable. So both those have been relied upon, and then other methods have not been used. So when other methods are available, it is not compulsory that those should be used. Those can be used, and then of course DCF and market comparable approaches, if there's sufficient data to substantiate these approaches, these will always be the preferred approaches.
So, in a way that like the Dave Burkus method, these are generally used at the stage of seed funding. You would prefer at that time?
Yes, most probably at that time. Because at that time there are no revenues to look at, there are like hardly any numbers that you can look at. So somebody at that stage will normally say that, okay, he will try and rate the management, try to give different scores to different parts of what you are looking at, what he's looking at. That kind of a method is done. And like people who have experience in deal making in startup companies, they will share with you that normally these discussions are done very informally. A person has an idea, he goes to a person to pitch on the idea, and normally it is simply that, okay, somebody will say that, okay, how much revenue will you earn after 5 years? The other person will give a reply, and then based on that the process starts, and then you get a share. So of course there is, like many instances, the calculations are there to support whatever the promoter is promising, or and the promoter's views are corroborated with certain data. But yes, frequently that is just a vague number. It can be conversation between an investor and a company can be like, okay, the investor will say that, okay, I want to invest in your company. How much are you ready to let go? The investee or the promoter says that, okay, I will let you take 20%, and I need maybe $5 million for that 20%. The other person they will say that, no, that's too expensive. Look at these transactions that have happened in the past. Look at this market. Look at the uncertainty that is involved. So therefore, for 20%, I will not be able to give you this much money. I will like to give you lesser money. Or rather, the question is the discussion is frequently very different. That, okay, the investor will say that, okay, I want you to make this company worth this much by doing this. So the investor, they will say that, okay, if you increase your presence from one city to 20 cities in India, then your valuation will increase, or your sales will increase to this number. And once your sale increases to this number, we know that, yes, then the market will accept this company at this price. If the sale is, say, an X amount, maybe the market will accept that company as half X or 1X or 0.75X of the sales. So in that case, the promoter will, the investor will simply say that if that happens, then he needs a 50% return or a 40% return on his investment year on year. And then that calculation gives that investor a number that, okay, he can invest this much in the company to make it go there. So what is happening? You're deciding the capital investment first. You're investing you're deciding on the dilution in equity second, and you're deciding the valuation last.
Right. So generally, it happens in the case of startups is that initial investors are generally angel investors, which are like friends and known people of the promoter. And the promoter, whatever value the promoter says that these investors agree, and then it becomes very difficult to justify that kind of high valuation. Maybe
Yeah.
you can share your experience on that.
So it does become difficult to justify that at some point, but then there is always some model, something in the mind of the promoter that he says that this is achievable, this is doable. There has to be a business model at the end of the day. There has to be some revenue that the promoter says he will earn at some point in time in the future. There is always some expenditure that he thinks will happen in the future. And we have a bias as valuers toward DCF because one, income tax prescribes it, and secondly, DCF is one of the methods that is understood widely by the regulators. Other methods are frequently doubted. So basically, I also have a bias towards DCF, and I think that DCF is always a good methodology to follow in all circumstances because it gives a more robust ground to a valuation. But other methods are also used in the industry, and their use is totally dependent on whether those methods are usable in the industry, whether there are comparables available, etc., etc. So let's move on to case study 2. So the case study 2 is again a pre-series A startup, and here we are looking at a company which is manufacturing ice creams and marketing and selling of those ice creams in South India. And then looking at we talk about how the company has two renowned brands catering to mass and premium segments of the market. Then you look at revenues with the EBITDA as a percentage. There is no debt. Then you look at the products that, okay, they sell cones, cups, they sell take home products, they sell sticks and all that. Then you look at distribution, how, the major market here you see is Tamil Nadu and Pondicherry, and then it is the second market that you look at is Bangalore, and that is how the distribution is done. So here what you can do is you can look at precedent transaction. You can see that, okay, that one entity called Hangyo Ice Creams had raised USD 5 million in funding from Capvent AG in August 2013. And then once you have that information, you say that, okay, Capvent holds 44% in that company. So what do? You say, okay, 300 is the deal value. You say percentage share required was 44%, and the implied equity value therefore is 684. You add the debt of Hangyo Ice Creams to this value to come to an enterprise value. Then you look at the sales number for this comparable company of Hangyo, and then you look at their EBITDA. You come at an EV by sales and EV by EBITDA ratio. Then you use these ratios to come at a value for your company based on its sales and its EBITDA. So this is something which is a comparable transaction approach, which has been reproduced here through an example. Any questions on this method? Any doubts on this method? Case study 3 is a relatively a transaction which is a traction stage startup, where you see that, okay, there is some artificial intelligence tools that are used in business to consumer and business to government transactions. these tools are what are this company is basically providing these tools, and that is what it wants you to value. So the growth rate in line with the companies is similar in similar segment, present orders in hand, and major pipeline. So these are the basics of the valuation. Major business segment was with the government, hence low sales estimated. So the government will not have very high growth. That's what you will estimate in the DCF that you're doing. Then we can use Nasdaq and the AI listed company database, ROC databases to find out data about comparable companies. We can look for methods. So method can be DCF, and then beta can be calculated based on Nasdaq or BSE IT companies, and then terminal value can be calculated based upon the present exit multiples with certain adjustments. Comparative study of other deals in India can also be evaluated using third-party M&A databases, and therefore you can then come at a value to the which you can conclude for this kind of a startup. So I think I will move on to the next slide, that is due diligence for valuation of startups. Any questions on the methodologies that we have discussed so far on the valuation methods for startup entities? If there is any, please share that with me. I will then move on to the due diligence. So this is the information that financial information that you will seek when you're doing a startup valuation in normal course. You will look for the financial statement analysis. You will look at all the numbers that are available. Then you can look at the capital structure, projections, assumptions, and financial analysis, market trends, capitalization potential, historical deals and projections achieved, customer acquisition cost of the entity, break even point, product wise, vertical wise, EBITDA, all this you can see. Then you can look at operational parts, that is what is the product market potential, what is the recent deal and similar products, what is the peer comparison, what is the management quality, growth rate and future potential, participant perspective, explanations with respect to that, fair demo of the product, term sheets, exit potential. You will like to discuss all that from the due diligence point of view. And this information will help you write your valuation report in such a manner that you will be able to ground all your assumptions with facts based on a strong will give you a strong basis to rely on, and also help you protect client as well as yourself from any legal scrutiny with respect to the valuation that you have created. So, any questions so far? Anything that you will like me to talk about more? I think we still have about 20 more minutes. I think we can have an interactive discussion on further questions with respect to whatever we have discussed so far.
Ankitji, have we covered the VC method, or you're going to cover it subsequently?
So the VC method is a method where what happens is that I will just talk about it briefly. It's a very simple method relatively. So what does a VC do? The VC simply comes forward and says that, okay, I can invest in your business, and the VC says that I will like to exit this business after 4 years, 5 years, 7 years, 5 years, 7 years, or 10 years, whatever is the life of the VC. And for that life of the VC fund, the VC will like to exit your company. So the VC creates a scenario and envisions the fact that he will be able to sell your company or sell the stake that he's buying in your company after maybe 5 years, 7 years, or 10 years at an X value, let's say. So what happens subsequently is that the VC says that if X is what your company will be valued at after this many years, then the VC will divide it from the rate of with the rate of return that he wants. So in case he says that my share will be valued at 100 rupees after 5 years, and he says that I want a 40% return, or I want a 30% return year on year, then he can do a discount. He can compute the present value of that value that he envisions for your company, for the share in your company, and then come at a value in today's time. That is basically the VC facility, VC method, where the VC says, okay, how much worth will your business be after 5 years, and how will you create that worth? So the promoter will tell the VC that my business will be worth this much. Why will it be this much? Because at that point in time, I will have these many users, I will have this much revenue, I will have this much EBITDA, and there will be this kind of a market for that business if that business is sold after 5 years. And then once that number comes out, then the VC will say, I need a 30% return on that, I need a 40% return on that on an annualized basis, and therefore I can give you this much money today. And then the VC will say that, okay, if I give you this much money today, will you be able to do whatever is required with that money that I give you to expand the business to the level that you are saying it will achieve after 5 years? So basically, it's a rate of interest, rate of interest, rate of equity or rate of return method on the perceived value of the business or of the entity after 5 year or after the investment period is over. So that is a VC method. Any doubts on the VC method? Any doubts on any other method?
Can I ask one more question?
Yes, sir. Yes.
So one of the factors, Ankitji, at the beginning you said is the quality of the management, and you talked a lot about this factor. So when we are doing valuation of a startup, how will you rate quality of management when we know that this particular promoter has failed in 4 or 5 startups, and this is his 6th startup?
I think I will use the opportunity to create some humor. And we have come across many promoters, and they say that, okay, we took an investment of 5 crore rupees, and we have lost that money trying to create a business model. And but they come back and say that it was a very, very learning experience. And so if somebody has failed in 5 startups, maybe somebody can say that he has got the experience from all those 5 startups, and therefore his 6th attempt will most probably be better as earlier 5. Jokes apart, I think whenever a founder, whenever a promoter starts a business, that promoter is investing a lot of his own time, a lot of his own effort in trying to create a business which is worth something. Of course, the promoter does try and get the basic salaries that are available in the market. He will try to find a niche for himself. In several cases, we have seen that the business starts with a different model and then ends up becoming a different model. And during that time, the promoter realizes, no, there is no skin in the game on the business that I was planning to do, and therefore then he changes his track or shifts to something else, something which is more realistic, something which is more realizable. So that also happens frequently. Technology changes as somebody goes along, a lot of things change. What is important to be understood is that when somebody says that, yes, I have 5 failed startups, more than that, we need to talk about what roles and what management decision making does that management knows about, and what is the management capable of. That capability may not be limited to the experience and failed startups, in my opinion, because those failed startups, you can never point out that what was the reason for this failed startups. The reason might be some other competitor going ahead, some other person getting more money than what our promoter did, some other person taking a lead or in the market because of their skill or some technology change that suddenly happened. It can be multiple things that can cause a problem. Promoter may not be the only person who is responsible for a failed startup.
Ankitji, one more question. Coming back to the question which I put up in the beginning of the session, that regarding verifying the projections of the company, when they are saying that initially they are not having that revenue, but in going forward in the near future, 5 to 10 years, they are going to earn it. Now, as a valuer, when I am seeing that projections seem unrealistic to me, but management is confident, and as a valuer, I want to safeguard myself, and I want them to give me signed projections also. Now, there's always an option, then I do 30%, 40% of projections which they have given, but then they will become my projections only. then they will not be their projection. Why? Because they will not give it in writing. Now, do I have an option that I take their projections and now do my own discounting? Either I inflate the discounting rate and call it a risk adjusted discounting rate, or I apply that CAPM method discount rate only, and later on discount it by say 50% or 30% depending on the high projection. So what should be the better approach in this case?
So Ankushji, the latest circular from IBBI, the IVS, and as well as all the rules and regulations that now apply to a registered valuer make it very, very clear that you can't say that the management, the projected financials or the projections were shared by the management, you have relied upon that and you've done your job. It has a very, very basic or a very, very strong requirement for the valuer to do some basic due diligence on the achievability of those projections, on the practicality of these projections. You have to corroborate it with the actual possibilities. So how do you normally corroborate a very, very high growth rate model? You normally corroborate it with the idea that you talk about historical data and say that yes, this kind of growth has happened in the field that you are valuing a company in the past. That might not have happened in the exactly the same industry, but if it is a technology space, if it is something which is very, very new, something which has not been explored, you will always have references like Flipkart, references like Uber, references like Google with you, where you see a growth in those companies, a rapid growth in those companies and their valuation methods. So based on that, you can corroborate and say that the management is feeling strongly about this new product. They feel that there is a market for this product, and yes, there is a possibility of failure, but yes, if they don't fail, then this seems to be an achievable model. And the failure rate or the failure thought process can always be put into the discount rate by keeping the projections high. So you can say that this is extremely risky, because somebody who is putting in money into this high growth model is taking a lot of risk that this might just fail. But the high growth projections can always be substantiated by past historical high growth performance by companies in technology or other spaces. This is what I think should be the method of valuing something that you have given an example for. And then the high discount rate can be based on the fact that there is this heavy risk that is involved into the company's valuation. That is what you can assume and put in a higher or additional risk premium to the equity risk premium that you've already, or the WACC that you're using in the model.
Okay. And what about using same discount rate and later on whatever value is arrived, then discounting it to say 70% or 60% considering? Is that method also acceptable?
That method is acceptable as long as you're discounting putting in that 30% discount factor for something like liquidity, DLOM or DLOC. So it's basically permitted, or it is something which is a custom for discount for lack of control or discount for lack of marketability in normal senses. But otherwise, I will rather advise that you adjust the discount rate or the projections.
And when we discount the project rate, we lose the formula which we generally apply, WACC method. So say WACC method says that it is 17.81. Now, when I use my risk adjustment, I would say that I will use 25. So I do not have any.
Not exactly. WACC is comprising of the KE, that is cost of equity, and the cost of debt. So whenever you're saying that there is a high risk required here, then you will end up increasing your KE by adding to the market risk, the risk-free return, the market risk, the market risk, and the discount and the beta. And you can add an additional additional amount towards the higher risk perception with respect to the projections that you're thinking out, because you're end of the day doing a private investment in most of these cases. This is nothing that is listed, or there is no comparable which is normally available on these very, very new industries that maybe you are taking an example of.
Right. And there's one more question, like when we do for startup entities valuation. So what they say is that equity as on date is say 10,000 or 1 lakh shares, but going forward it will build up to 10 lakh shares. So when we calculate per share value, so that number of shares should be post issue or before issue. That means what they have projected or before.
There's always a pre-money and a post-money valuation, and that the differential between that is, of course, the number of shares as well as the value that is coming into the company. The normal process is to do a post-money valuation and then deduct the money that is coming in to compute the pre-money valuation.
Okay.
Because the basis of the projections is that that money will come in and that money will suddenly go into the company and create a growth model. So you have to create that, and therefore you have to compute a post money valuation in normal circumstances and then compute a pre money valuation based on that.
Okay, understood. Thank you.
Any other questions? Vijay, do we have any questions on the chat box that we can take up?
Chat box में तो हैं, chat box में हैं. Reviewing projections and assumptions. For projections critical, we need to get comfortable. There should be three-party validation of projections for a valuer to rely.
Okay, I have a different opinion. I think when the valuer is getting a fee for a valuation exercise, adding the fee for a third party validation of a projection will only make things complex. I don't think it will add any value to anyone, because end of the day, the company is supposed to give you projections. You're supposed to vet them as a valuer. If you're comfortable, you should say that, okay, these are achievable projections and give a value based on the same. In several instances, what we have done is we have not even received projections from the management. We have just created projections of our own. That has also happened. So that is also something that becomes a skill set then for a valuer, that he can just create projections based on the data available with him. Especially in IBC cases, going concern valuations, you have to do that. Management does not give you anything at all.
एक MS जी का क्वेश्चन है, he is a new registered valuer, जैसा भी एप्लीकेशन में पेंडिंग है. How much normalization to PL figure is necessary, such as correct level of management expenses?
So whenever you look at a company which is a startup, I think he's referring to this scenario where the management, the promoters of a company will not take any formal salaries from the business, but once the investment comes in, they will try and take home whatever is their market salary. And that is supposed to be taken care of in the projections, because whenever that money is invested by some investor into the company, what happens is that the promoters are no longer able to take out any money from the company, and therefore the promoters need some money to run their household, have a reasonable standard of life while their company is growing up. So the basic premise, I think I've not mentioned it, the basic premise is that the moment there is investor coming in into a company, the possibility of the investor taking home any money is very minimal. So either the investor will have to, either the promoter will have to sell a share, sell a stake to get some liquidity that he can use, or the promoter will have to take home salaries. These are the only two ways that the promoter can take home any money. So we still have 5 minutes. Anyone who will like to contribute anything? I think anyone who will like to share something that everyone can learn from, or maybe something we can discuss.
आप तो इंसोलेंसी का काम भी अच्छा कर रहे हो, तो क्वेश्चंस आपके कम आ रहे हैं मनीष जी. मनीष बुचासिया जी, मैं आपसे बात कर रहा हूँ.
नमस्ते जी सर, मेरा क्वेश्चन ये है कि इन केस ऑफ प्राइवेट प्लेसमेंट there are two valuation certificate is required if the share are issued at premium. One from the registered valuer under Companies Act 247 and one under 56(2) by merchant banker.
Right, sir.
Can we postpone the merchant banker certificate on the date of scrutiny, as well as right now we will not acquire the merchant banker certificate and file after the statutory return?
In my opinion, the merchant banker certificate, if you're talking about a FEMA compliance requirement, the
no, there is no FEMA.
नहीं, अंकित जी सिर्फ 56(2) के लिए कह रहे हैं. मनीष जी सही कह रहे हैं.
56 आप इनकम टैक्स की बात कर रहे हो, और आप कह रहे हो दूसरी तरफ प्राइवेट प्लेसमेंट हो रही है, तो प्राइवेट प्लेसमेंट में कंपनीज एक्ट में रजिस्टर्ड वैल्यू से सर्टिफिकेट चाहिए, दूसरी तरफ इनकम टैक्स में सर्टिफिकेट चाहिए फ्रॉम अ मर्चेंट बैंकर, so that you can say that the shares were acquired at fair market value and there is no tax payable by the company on the receipt of share application money from the investor. आप ये कह रहे हैं.
मेरा क्वेश्चन ये है कि मर्चेंट बैंकर का जो सर्टिफिकेट चाहिए,
so in my opinion sir, merchant banker certificate should be obtained when you are getting that money. It should not be postponed, because when you postpone it, the whole idea that the projections were used for the date on which the money came in anyways gets spoiled.
Because the certificate is not required to be filed anywhere from the merchant banker.
I understand, and I think it will increasingly become difficult for merchant bankers also to give any backdated certificate and all that.
No backdated.
I think
valuation
it's better to get a certificate and get done with it.
Yeah. Taking a certificate is advisable. Okay.
Yes.
Thank you very much.
विजय जी और किसी को जगा सकते हैं आप क्वेश्चन के लिए? मनीष जी ने तो एकदम से क्वेश्चन पूछ लिया. मनीष जी, एनीथिंग दैट यू वुड लाइक टू कंट्रीब्यूट फ्रॉम योर एक्सपीरियंस?
मनीष जी थोड़े से संकोची हैं, अच्छी प्रैक्टिस है इनकी.
मनीष जी, इसीलिए मैं मनीष जी से पूछा. मनीष जी, एनीथिंग दैट यू वुड लाइक टू शेयर ऑन
my one question is related to my latest valuation which I am going to doing IBC. Okay. Right now we are not because the CIRP date is something around in March 16. But the statutory audit is not been done. Balance sheet is not yet filed. RP has already initiated the Section 19 application against the chartered accountant as well as the management. Okay. So in this circumstances, how could I conclude my valuation? RP say that you just do whatever you want. You say make the draft report on the basis of provisional data. So,
sir, financial statements, if they're not prepared on CIRP date, they must be available for some date. So is that date very, very old, or is that 2019, March 2019?
It is the 1 year back.
So March 2019 financials are available with you.
Yeah.
You also, the RP must be also be in control of the assets of the company or the corporate debtor to a limited extent where you can do a physical verification of whatever is happening there.
But I am looking for a financial assets only. That's why I need a financial data.
So if the financial asset data is not available, the ledgers are not available, the books of accounts are not available with the RP, you will perhaps have to tell the RP that there is no possibility of valuing them in absence of that data, and you will have no option but to value them as nil, unless and until you find some data which is relevant. So as I think I discussed a little bit yesterday, that you can look for, maybe the latest balance sheet, you can look for the ROC data, you can look for so if the list of debtors is also not available, now that also becomes a very, very difficult thing. Then you are left with no option but to value it at zero. So as long as that information is not available, the valuation report is what it is. It is something that has to rely on the available information. Okay. And if that kind of a valuation report, draft valuation report, is required by the RP for some purpose, then it should be shared. Because if the RP is relying on your valuation report to take a decision which is required to be made by them in the COC, then that should be available with them.
So shall I share my partial report, like whatever the data, whatever the like receivables and stock, all the things is there? I can share the partial data only.
I think you should share your final draft report as on based on whatever you can prepare, whatever you can use.
Disclaimer.
So it should not. So it should be that I always say that the draft valuation report should be the report that is accurate to the best extent, as long as there is no new information that comes to you.
Okay.
So the moment new information comes to you, you have the right to revise your draft report and make changes in it. But if new information does not come in, it should be accurate to that extent.
Thank you.
Participants से request है, please questions पूछें. मैं थोड़ा सा वैल्यूएशन कम पढ़ रहा हूँ, नहीं तो फिर मैं ही क्वेश्चन पूछ लेता अंकित जी से, सबकी भरपाई मैं ही कर देता. अब मुझे लगता है मुझे पढ़ना पड़ेगा अंकित जी. अब आरबीओ की जगह ना आरबी का रोल मुझे करना पड़ेगा.
I think आप जितने सेशंस लेते हो और सारे सेशन सुनते हो, तो आपको ज्यादा पढ़ने की जरूरत नहीं पड़ेगी. सबसे पार्टिसिपेशन में जो रिटेंशन होती है वो बहुत ज्यादा होती है विजय जी, बहुत ज्यादा होती है एज कम्पेयर टू रीडिंग एनी.
मैं वीडियो जरूर बंद था मेरा, ऑडियो एक बार भी कान से नहीं हटा था, क्योंकि किस समय आपने मेरे को आवाज लगा ली, मैं पूरा सुन रहा हूँ.
हाँ, बिल्कुल सही है.
So we are closing this session. So thanks all the participants, and a special thanks to Ankit ji, who is asking on regular basis की questions को पूरी तरह से टेक अप कर रहे हैं. Not a single question is pending. और आप सबके लिए अच्छी चीज है कि आप अंकित जी को कभी भी कांटेक्ट कर सकते हैं. He is always available. Has a very large team of valuer. तो आपको हर तरीके से सपोर्ट कर सकते हैं इन फ्यूचर इन एनी असाइनमेंट्स ऑफ व्हाटएवर यू आर डूइंग. स्टार्टअप है, बड़े से बड़े असाइनमेंट्स हैं, बड़ी से बड़ी वैल्यूएशंस हैं, तो सभी तरह के प्रोजेक्ट्स अंकित जी हैंडल करते हैं. सो थैंक्स. और कल हमारे इंटेंजिबल्स के ऊपर सेशन है, एंड देन 4 सेशन ऑन डिस्क्लेमर्स, जिसके ऊपर अंकित जी का भी सेशन हम अपने NIRC में ले चुके हैं. बड़ा अच्छा सेशन था. लेकिन इस बार की हमारी फैकल्टी सुमित दत्ता जी हैं, क्योंकि सेम फैकल्टी को देख देख के कहीं आप बोर ना हो जाएं। नहीं तो अंकित जी को तो हम पकड़ के रखते हैं हमेशा।
In fact,
मेल भी कर सकते हैं।
in fact, Vijay ji, I will love to listen to the next 2-3 days of webinars, and सुनने से और शेयर करने से जो knowledge बढ़ती है वो हमेशा बढ़िया रहती है। So I will love to be part of tomorrow's, day after's webinars, and I think it will be my pleasure to be part of them, and I will talk to you about it. I will be part of them. All right,
कल के गोपाल जी हमारे। Thank you.
Right. Thank you, everyone. Thank you so much. Thank you, Vijay ji. Thank you so much for allowing me to share my experience and share whatever I know with everyone. And thank you, everyone, for asking questions and making this an interactive session. I'm sure it helped me learn from whatever we shared today in this group. Thank you so much. Thank you.